Hey, I'm here today with Catherine Avery. Catherine runs our dividend focus strategy and is with Catherine Avery Investment Management. Welcome, Catherine.
Welcome. Thank you, Leah. Welcome to you too.
I think this is a really interesting time to talk a little bit about what we're seeing in the market. Obviously, since you and I last visited, it seems like that was a lifetime ago. So much has changed. Something that's interesting, certainly, to talk about are valuations today. So we look at an environment where NVIDIA just crossed $4 trillion in market cap yesterday. And to put that in perspective, NVIDIA is worth more than the total aggregate market value of all the publicly traded companies in Germany and all the publicly traded companies in the UK independently. And I think that's just absolutely remarkable. So I'd love to know kind of what you're thinking about as it relates to valuations and how you're looking at the market.
Yeah. Well, if you've gotten my letter or the letter that Jeff had written, he starts it out with saying, well, was an interesting quarter. And he's certainly right. It was like the shortest, correction or, downturn that we've seen probably in history. The quarter wound up being so strong. I mean, we ended the quarter up about 8.6% just for the quarter, and the year up 9.6%. So it was a wild ride for us, completely straight up. But we're at this point now where the valuation in the market it's almost 24 times forward earnings. So, it makes you kind of nervous. One of two things has to happen. Either it's going to grow into it with earnings estimates going up, or that uncertainty that we're seeing is probably going to sink in and maybe perhaps have a further correction. But we'll see. A lot of the portfolio and the market even itself was driven by the tech names last quarter. And, we've had about 50% returns on average in each of the stocks in the tech sector. Unheard of. So again, mindful of valuations, but when we look at our tech representation to what we would normally call the Mag 7, which the general marketplace tends to look at, again, there's a huge difference in valuations. Okay, so the tech sector on average at this point in time is trading at about 32 times forward earnings. Our portfolio tech is trading at 23 times. So, almost like, a third of a difference in those two valuations. But we're starting to see now that a lot of the names in our portfolio are getting a revaluation because they tend to be the infrastructure or supply chain that supports the AI. So a lot of these companies that, were trading at lower valuations, people are starting to say, oh my gosh, I can't believe that there are these prospects within this company, and they're going to start supporting that whole AI structure. And then you're going to start to see earnings expansion, multiple expansion. We're seeing good dividend growth in that sector as well. So it's this weird dynamic going on, at least for us, where the tech has been not only offensive, but also defensive as well.
I think that's a really good point. I was actually reading something the other day, and it was talking about gross margins of different sectors. And of course, the margins of the technology sector have always been high, especially for software companies. And I think gross margins were around 43%. But what a lot of people probably don't necessarily know is like utilities are in the high 30s now. Healthcare is also in the high 30s. I mean, but multiples are dramatically lower, to your point. So the question is, are we, and I think we are starting to see a rotation, but I would love to hear your thoughts on kind of the changes that we're seeing in the market. And do you think the market is going to start fully reflecting some of those fundamentals and develops of companies that are beyond the NVIDIAs and the Microsofts in the AI chain?
Yeah, what was interesting, Ed Yardeni had a chart out the other day, and he had the Mag 7, and then below that he had all the other companies in the S&P 500. And while those companies were up 50%, the S&P 500 companies, from that downturn, were up 20%. So I mean, 20% is a nice return. I mean, it's not as high as 50, but still, it's a nice return for one quarter. So I think you are definitely starting to see that, and the marketplace wants to broaden out. They don't want to be so dependent upon these names, because at least the ones that are at higher valuations, we have to also take a look at, what's the CapEx going to look like for these companies, and does that hit a wall at some point? And so that's why you have to kind of look below the surface and look for these other areas that beneficiaries of AIs, other interesting things going on. Like you and I talked about the healthcare sector. The
Yes.
healthcare sector, boring, sleepy, paying great dividends. Nobody wanted to look at them last quarter. But underneath the surface, with all those good dividends, there are these interesting portfolio revisions that are going on, because as the drugs are coming off patent, they're looking for new ways to grow, and they're getting involved in cancer therapeutics. And Merck just reported one the other day where they did an acquisition. And the Keytruda, even though it's going off patent, has so much cash flow that it completely funds the new acquisition. And again, we see that in other names in the healthcare sector as well, with the cancer portfolios underneath the surface that haven't really hit yet. But, eventually those will kick in, and it's going to be additive to cash flows, additive to dividends, and then you'll get that multiple revision as well to the upside.
Yeah, I think healthcare is one of the areas that I think is most interesting because valuations still remain relatively low. And you're right. I mean, if you see the amount of cash flow that has been generated from, you mentioned Merck, but from the GLP-1 companies, and even from the Abbotts and the Becton Dickinsons, the companies that made the COVID test kits, right? They have all this cash flow to be put to work, and the biotech industry has really been penalized because they need financing and rates have been higher. And so multiples are lower in that area. So I do think that's a fascinating area to kind of watch moving forward.
Right. But it's been a good place for us to hide out, and it does provide some good support in the portfolios. And as I said, there's some of the names that are actually doing well for us so far in the first 10 days of this month.
Which is fantastic. And I think you bring up another great point about whenever we have these big moves in the market, often they are led by a particular sector, and the market becomes relatively narrow. And in order for a rally to be sustained, either the leaders roll over and that leads the market lower, or you do have the laggards start to catch up. And it seems like the latter is starting to play out, which would be much more healthy, obviously, moving forward. And I'm kind of curious, you mentioned healthcare. What other areas are you seeing some outperformance in July versus what you saw last quarter?
Well, financials is another area, so we have this whole deregulation going on in the sector. And that's one of the positive things that we actually have going on so far this year. So they're going to be beneficiaries of that. They start reporting next week. Usually they tend to underperform going into the earnings, and then they come out looking pretty well. But, they're going to be announcing capital requirements, and capital requirements are going to be coming down with the new regulation. That's going to be additive to their bottom line. And we're seeing great dividend increases out of them. We did our Dividend Champs piece about a month ago, and JP Morgan happened to have been on that list. They've increased their dividend over 12% so far this year, and we expect to see more of that with the other names in the portfolio as well. So financials is one of them. Let's see, what else we have there in terms of sectors. I think consumer staples is going to be another area that people start to look for. Look at, McDonald's, Coke, what they've been doing recently. Laggards last quarter, but, people are moving forward with them this quarter. So the market's rotating into those underdogs.
it is very encouraging to see, and there are so many interesting things going on with so many companies. Despite, I think what a lot of times people are focusing on are what's happening from a policy perspective, because there is so much. There's noise, and then there's what is actually occurring, right? There's a combination, and on that topic, I'm kind of curious because the tariffs are still exceptionally relevant. I'm kind of curious what you're thinking about the tariffs, and I would love to know your thoughts on the retail space as well.
Yeah, well, and that's another interesting thing, because there were some retail stocks that were actually rallying today in the face of all these tariffs. So go figure. But again, the valuations are there. And the one thing that is certain is that the tariffs are in place, right? So we've known that for quite a while, and those stocks have taken a downturn in regards to price. So maybe all the bad news is somewhat in there. But I think as we get deeper into the woods in the earnings reportings, we're going to start to see that companies are beating, but they're not raising. So it's probably either going to be a beat and hold or a beat and lower. Market doesn't like beat and hold or beat and lower. They only want to see a beat and raise, and we've kind of gotten accustomed to that. But I think there are so many unknowns relative to the tariffs that I don't think a lot of these companies can really start to think about how it's going to be affecting them. We have seen some instances in the food companies, especially the ones who have packaged foods, aluminum cans. Believe it or not, aluminum has a 40% tariff that's put on it. And those companies, like the food companies, are starting to see that they can no longer really pass on that to the consumer, because the consumer is not going to take it. So they're going to have to eat that. That's going to hurt their bottom line. I would like to think that at least this is just a short-term issue, and always hopeful that there's a resolution to this down the road. And I have to say, if you watch Trump's actions, he gets to that point where he sees like, I don't think I can push this anymore, and then he kind of changes the rules a little bit. So I think we're going to have a little bit of that happening. I mean, because listen, if he pushes this too far, he's going to drive the country into a recession. I don't know how much he really wants to have that. It would be good for him to lower the rates, for the 10-year rate, but I don't think he really wants to say that he was the president that pushed the country into a recession.
I agree. We definitely seem to get to a line, and then we back off, right? And even it seems like in the last few days where we've really pushed tariffs and drawn a hard line are not necessarily large trading partners. So it's been like Brazil. It's been smaller markets so far. So I'm really curious to see how it plays out. And I'm very surprised to see that we didn't see the big pull through in inflation, which is what myself and others were concerned about. So I think it's going to be really interesting to see when retailers report. What we're kind of seeing is that language from what we heard from Walmart and Target, a few months ago. Is that going to change?
Yeah, because a lot of those companies are so dependent upon China, Mexico, for a lot of their goods. And those are the countries that we really haven't done any finalization of what the tariff is going to look like. So, I mean, I guess you could just say is that, uncertainty is just going to be part of our day-to-day life, and what we have to deal with here in the financial markets. But, the focusing on quality, focusing on yield, focusing on the ability to grow and be profitable, I think is going to continue to be important in the clients' portfolios. And I think that's, one of the things that we do differently from our competitors is that we focus not only on that higher yield, but also that ability to get growth. How far can we push that yield on the portfolio and still be able to get that growth in earnings? So we get that growth in the stock price.
And I think I think you're hitting on one of the key things that clients are really thinking about today. And I think advisors are really thinking about today is how, given all the uncertainty, how do you make sure that, your risk management and you're thinking prudently about how you're allocating capital. And that certainly sounds like what you guys are doing as you're thinking about the names in the portfolio.
Mm. Yes, we have an eye on it every day.
Well, thank you so much for Catherine for joining us. I appreciate it. And I always look forward to our conversations and look forward to us doing this again soon.
Same here, Leah. Happy summer, everyone.